not every private equity firm is the same. Maybe they're value focused or maybe they're a bit more patient. All of that is going to influence a lot of things surrounding sourcing, but also as it relates to our conversation today, how you structure the compensation.
Imagine your sourcing team is so perfectly aligned with your firm's goals that you crush annual capital deployment targets with seemingly endless private equity deal flow. What if you had such deep insights into structuring incentive-aligned sourcing-first compensation packages that you not only generated predictable, repeatable, and scalable capital deployment, but your sourcing team members all hit their on-target earnings by delivering new, fund-returning portfolio companies to the firm? My co-host Matt Rooney has built and scaled a private equity deal sourcing-focused recruiting firm called Coastal Partners. He's sharing his insider perspective on how sourcing professionals are compensated today, how market-leading private equity firms are building fund-returning deal sourcing teams, how to get the most out of investments in in-house deal sourcing, as well as how you should think about structuring base, bonus, and carry compensation to lock in long-term, predictable, repeatable, and scalable capital deployment. In this episode, you'll learn rates and ranges for market on-target earnings for sourcing professionals by tenure.
For a senior hire, 15 plus years of experience, we're getting into the 500, 750.
How to think about the mix of base, bonus, and carry to maximize performance.
In years where folks have success, the bonus can far surpass their base salary.
How to align BD comp with your firm's goals to ensure you hit them.
65% of the 150 or so people that participated in our survey last year were just discretionary. The other 35% had some form of success-based bonus.
And why business development professionals may lead the way in the future of private equity.
The gap between the deal team and the BD professional is narrowing. I'm betting that will continue to happen.
Stay tuned for a masterclass in BD comp structures from a recruiter whose middle name might actually be Deal Flow. This is Deal Sorcery. I know one of the things we wanted to talk about today, and I know it's a conversation a lot of people are interested in, is like, what does compensation look like in this space, right? And I think both from a firm perspective and an individual perspective, like there's a lot of interesting things for us to dive into here. Let's start off with the first piece, which is like, what is the typical comp structure for BD professionals in private equity look like? What are the different components of it? And then like, what do each one of those components look like?
Yeah, for sure. I mean, simple answer is base, bonus, and carry or some form of equity, right? That's the typical structure in private equity compensation to begin with. And it's the same for business development folks. We'll get into how those pieces might be broken down differently than deal team counterparts. But the three main pieces are base salary, bonus, and then hopefully some form of carried interest or equity.
And so is there any other comp pieces outside of that you're seeing? I mean, because I feel like, sure, you got your standard base, and maybe there's a lot of things rolled up inside a bonus. Maybe that's the right way to think about it.
Yeah.
So we'll kind of double click into the bonus piece. So let's start with base then. What are the ranges of base? And I'm sure obviously it varies from level of experience and firm that you're at, size of firm, location, all that sort of stuff. But like, can you help maybe characterize, I guess, first, like what are the factors that influence base? And then maybe start paint the picture a little bit for like, what does base look like given different scenarios?
Like you said, all of those kind of typical factors that are going to influence compensation of any position are at play in BD, right? So the size of the fund, the location of the position, the experience level, seniority, is probably number one. But all those things are going to play a role naturally because of a lot of things we've said here, because of its relative newness as a function, in the industry. It's the averages are skewed, by the varied approaches. If you're hiring, it's a senior position. If you're hiring someone with 20 years at an investment bank versus someone, with 15 years in software sales or 10 years in software sales, the comp package is going to look very different. The averages will capture those two, but I'll just give you some rough numbers here. Like if we were talking to a firm thinking about a hire, the kind of ballpark numbers we would share. Just for all-in cash. So let's include the bonus, the expected bonus. For a junior hire, someone with 2 to 5 years of experience, I would ballpark that at 150 to 200 all-in cash. Again, we're going to talk about what drives the bonus, but That's for junior hires. For like a mid-level hire, maybe 8 to 12 years of experience, somewhere in that range, give or take a few years. I would put it at 300, 350 to 450. And then for a senior hire, 15 plus years of experience, we're getting into the 500, 750. And all of this is, these are just ballpark numbers. Of course, there are people who are, outside of these ranges, depending on important factors, but those are kind of the loose numbers that people can think about.
Are the numbers you're quoting, are those on target earnings, like all in sort of numbers? And does that include carry, or is that just base? Does that include bonus? Like just help me fill that in a little bit.
Yeah, all in cash. So base and bonus.
Got it.
We'll talk about how bonuses are structured, because there is a high variance to bonuses. So but that I think just as what someone will earn annually, all in cash, separate from any carried interest, is what I was getting at.
Got it. So what we're saying is all in cash, base and bonus. We're talking about a junior 150 to 200K all in, mid-level 350 to 450 all in cash, and for somebody senior level 15 plus years experience, 500 to 750K all in cash base and bonus for the year. Is that right?
Exactly. Yep.
What does the split look like there? I mean, to me, I always thought about designing these things around kind of a 50-50 split where, like, of your on-target earnings, if you have 200K of on-target earnings for a junior, like half of that is base and half of that is bonus. But how does that typically break down, and how are folks treating it today?
I think that's the right way to think about it. It's more often that way, 50-50. But there's a lot of different approaches. We're going to get into some of the incentive-driven bonuses, and in years where folks have success, the bonus can far surpass their base salary. And we'll kind of talk about the merits of that structure. But I'd say loosely, just as like a rule, think about it the same way a deal team member would think about their comp. Like it should be close to 50-50 base and bonus.
So like if I'm just doing the quick back of the envelope math here, like what we're functionally talking about is, if you're a junior, like you're talking about a junior, like how are we characterizing junior? Is that like 0 to 5 years of experience, or like what's
the range that I gave was more for someone who has at least a couple of years of professional experience. Okay. So 2 to 5 years. Okay. And I put that at 150 to 200. So on that one caveat is I would say the base salary is generally 100,000 or above. So it's not a equal 50-50 in that case. I think maybe that is influenced by a junior hire in their first year is less likely to have a successful outcome. So heavier weight towards a base salary. From that point on, I think you think like senior associate, you get into mid-level, VP and above, it's typically a 50-50 split.
It sounds like generally the right way to think about this is like there's a variance around each of these buckets, but as we're talking just about base, like junior level folks, we're talking 2 to 5 years experience, maybe around 100K base sort of range, right? Like for that junior 2 to 5 year. And then somebody that's mid-level, if we're calling that 5 to 10 years sort of experience, 5 to 12 years sort of experience, like we're talking about a base in the range of kind of like that 150-ish, again, plus or minus some sort of range there. And then to the extent somebody is like a super experienced, senior level hire, we might be talking about a 200, 300 to up to, it sounds like even close to 400, like 375 sort of base range. Is that the right way to think about it?
Yeah, for sure. I think just consistent caveat is that there are all these different factors at play here. There are plenty of people who are outside of these ranges, but I think that's a fair way to lay it out.
To be clear, right? Like we're not trying to set the range of like what every firm should be paying here, right? And like we're not saying that this is what every firm is going to be paying. And there's lots of different things that weigh into that, right? Like I know even just from Sarent days, like we might have, for instance, had a lower, base salary, but we also had like a much higher bonus structure where like you almost have unlimited earning potential, right? And that works for some people, but it doesn't work for others, right? Where like I know, for instance, we lost out on candidates where, they were a junior hire, and just like you're talking about here, like the base structure for a lot of juniors might be in that range of, 75 to 100 to 120 sort of base. But I had juniors that I was interviewing and we put offers out to, and the offer was like, our base is in that range, right? Like we're providing a base that's
Yeah.
in that range, but they were showing me competing offers that they had where they were getting 140K base, but their upside was limited, right? Where they could only get like 25K in total bonus, for the year. And so I just like, and sometimes it's hard to, and like, that's not apples to apples, right? Like I'm telling you, you gotta,
Yeah.
it's a lower base, but I'm telling you, you can earn $800,000 per year, right? And so yeah, it's not one size fits all for sure. It's going to depend upon the firm, and I think both for people and for firms to understand, like there's a lot of room to wiggle around this and a lot of different ways to structure it. But like generally, these are the kind of the ranges we're seeing, right?
Yeah, you have to start somewhere, right? If you're thinking about this, like these are just guidelines.
Super helpful. Okay, so we've got the base piece figured out, right? Like we have a sense for what those ranges look like. Bonus, like I feel like there's a ton of different ways folks approach bonus, but can you just give us a lay of the land of how are different firms approaching bonuses? What types of different bonuses exist, and then maybe we can double click into each of those.
We did a comp survey last year, our first comp survey, and so we can refer to some of the info we pulled from that. We're probably launching that one pretty soon, so I might have a different answer for you, in a couple of months. But from our first survey, the majority, I think it was about 65% of the 150 or so BD people. So it was, only a fraction of the whole market. But I think it was 65% of that share of respondents have discretionary bonuses solely. So just like investment professionals, just like deal team members, 65% of the BD people that responded to our survey just have that kind of, this is your target. And if we, feel like things went like they should, you should get 100% of your target. If we exceed, if we have a really good year, then maybe it's north of there. But nothing tied to success or any sort of metric that they were tracking. The remainder of that pool had some form of success-based bonus or incentive bonus.
That's surprising to me, right? So you're saying like 65% of this market is discretionary, even though like what you're really looking for is performance, right? And so like what that means, I mean, correct me if I'm wrong, but like what that means is like, even if I go deploy $100 million per year as an individual, which is like a really good year for most people, the firm could still say, yeah, like, we decided your bonus is this.
That's it. And I think the opposite side of that is if I do a really good job and get a ton of shots on goal, but for some reason we weren't able to win those deals, or, we're in a year where we're not deploying money as well. Maybe it's macro factors. Maybe it's something out of my control as a BD person. I'm still going to get compensated kind of where we agreed upon.
Fair enough. Right. Okay. So it's like, look, you're putting in all the right inputs, right? Like I see you putting in the work. I know you haven't gotten a deal done, but like we're still going to give you the bonus.
Yeah, and I think that's where it kind of takes us to like what we think is the right way to structure this, and we'll probably talk more about it soon. But those metrics, I'm sure, are influencing every BD professional or almost every BD professionals. Like how many LOIs did we issue? How many NDAs did we sign? Like there are metrics that can guide that, and maybe that is built into the the decision on the discretionary bonus. But just to make clear, we're talking about discretionary bonuses, and then the other side of that is either success-based or incentive-based bonus, where an actual dollar amount, an actual bonus is granted if you
like hit a certain metric or whatever.
Yeah, if you exceed a certain amount of meetings booked, if you arrange a certain amount of calls with business owners, or if we issue a certain amount of LOIs to deals that you sourced, those are out there. And I think anecdotally, I said 65% of the respondents in our survey, that I think anecdotally, I'd probably guess that it's closer to 50-50 with the incentive-based bonuses versus discretionary. I think that there are more people out there that maybe just didn't participate in our survey, and they will this year. But I think it's probably closer to 50-50 because all the conversations we have, there are a lot of, especially the firms with big teams. If you're building a big team, I think you're using metrics and you're offering success, when deals close and go in people's favor, and building that into bonuses.
It brings up an interesting question. Like, and I don't know if we have the data to support this one way or the other, but when we look at the breakup between some of these big teams, that are established, that have, I'm just going to say, like have 2 to 5 plus, right? Versus we talked about there being 200, folks that are just single person BD teams. Do we know or have any sense for it? Is there a difference between what the bonus structures look like depending upon the size of team? Like, is it something where these small teams, for instance, more often it's discretionary because like that's what they do with the rest of the investment team, and that's kind of what they're used to, versus like the bigger teams kind of tend or trend toward this more incentive performance based bonus structure?
That's how I see it. I mean, anecdotally, I think that's the way that it ends up happening, where you have an individual who maybe was hired directly into this role, or maybe they assumed it. They were on the investment team and they assumed the role.
Yeah.
Their compensation is not going to be, the firm does a deal and you get paid every time that happens. It's more likely that they're going to be set up on a kind of traditional investment professional structure where there's a discretionary bonus. But the teams, I think it's kind of necessary. You build out a big team, you have a large coverage area. It's often difficult to like grant credit, if you don't have these metrics and if you don't have a clear distinction on how these folks are going to be measured. So I mean, just looking at some of the names that we mentioned before, almost all of those teams are compensating on both metrics tracked and success. If you are able to source a deal that closes, you have a larger bonus. So I think that's just part of building a BD team.
So we think we talked about the discretionary piece. Like obviously that makes time, the partners or the comp committee or HR, kind of et cetera, to decide what that comp piece is. Let's double click on this performance based piece for a minute, right? Because my sense is, and my experience is, like there's a lot of different ways that can look, and there's a lot of different subcomponents to that. But perhaps just focusing on individual compensation for a minute and individual bonuses, the ones that are performance based, like what are people typically measuring there? Is it purely just deals closed? Is it something else?
So as far as how it impacts someone's bonus or someone's compensation, I think it's most often because BD groups are measuring all different metrics, right? But for as far as how they're in compensation structures and bonus structures, it's most often meetings booked, LOIs issued, maybe it's NDAs signed, and then deals closed, platforms versus add-ons, things like that. So those are the most common ones that we see, but firms are certainly tracking more than that.
Do you find, like, at least my experience is the majority of performance-based compensation tends to fall into either deals closed or dollars of equity deployed or total enterprise value per year in transactions? But like, what have you seen? Like, what are the biggest buckets?
So deals closed, you can either see that this is just a flat bonus for when a deal closes, and maybe it's a bigger one for a platform, a smaller one for an add-on, or it's a percentage of the total equity that we deploy, right? I've seen both, and certainly the percentage of equity deployed can be pretty significant. So, that might be more appealing. But I've seen firms that just have kind of flat bonuses based on whatever type of deal it is.
Do you see one that's more common than the other in terms of like just, hey, I get X dollars? Because I've seen like some firms will be like, hey, it's $25K per every platform deal that you get done or whatever, right? Regardless of kind of the size, versus again like the other where it's like, hey, percentage of total enterprise value or percentage of dollars of equity deployed. Like, is one more common than the other?
I don't think so. Again, it's not something that we tracked. It's kind of hard to fit this into a survey. Although I'll be trying to do it after this discussion.
Yeah.
But I'd say just anecdotally, it feels like it comes up, an equal
amount between, whether you just get a flat amount per deal closed versus like based on total enterprise value or dollars equity deployed. Okay. Do you find that there's people that are often compensating for meetings booked and LOIs and some of that sort of stuff? Because I've seen both approaches, right? And like my experience is like you're trying to incentivize getting things all the way to the bottom of the funnel, but to the point we talked about earlier, like around the discretionary piece, even where we're saying like, gosh, like I did all the right things, I still didn't get a deal done this year, right? So I have seen, and we talked about and pushed for doing some of this stuff where it's like, hey, do you compensate people for LOIs signed or something else that's up the funnel? But like, is that common today? My experience is it probably not, but maybe I'm wrong.
It's all relative, right? It certainly exists. It's not the majority of BD professionals, but among a good portion, like we said, 65% of the 150 or so people that participated in our survey last year were just discretionary. The other, 35% had some form of like success-based bonus, and LOIs signed was a big portion of that. More anecdotally in kind of recent searches that we've worked on and conversations that we've had, we've seen more, some of the bigger teams utilizing meetings booked, particularly surrounding proprietary sourcing, right? So if that really kind of only applies, I think, like you're not going to, incentivize someone to have more meetings with bankers, although important. It's just not as difficult to get a banker, to take a call with you as it might be for like a qualified owner of a business or a target company. But yeah, I mean, that's certainly a way that firms structure these bonuses.
You're bringing up another interesting point, which is like, how does comp differ on the performance side of the equation for proprietary versus intermediary source deals, right? Because like we've talked about the fact that the majority of professionals that are doing this today are still like a big chunk of their job, if not 75% of it, is like focused on still sourcing via intermediaries, right? Like, and having coverage of your bankers. So like, does that comp differ? Are you finding folks saying like, hey, we get paid more, for a deal that's sourced proprietarily versus like something I pulled in through an investment bank because I had my coverage game going?
Yeah, for sure. I think that's a reason why. There are reasons why firms are trying to go after companies directly, and source proprietarily. There's an advantage to being able to have a one-on-one relationship without a bank and without having all the other buyers in a process, and that is something that firms are trying to incentivize with their BD professionals. So it's certainly out there, and I've seen it, in firms that have maybe even firms that have flat bonuses for success will have a higher amount for a proprietary platform versus a banked platform. So it's certainly out there.
Have you seen any numbers for what it might look like for sourcing an add-on versus a platform for folks?
It's certainly a lot smaller in those circumstances where there's like a flat bonus. That share I've seen be a quarter, or less than that, a fifth or a quarter of the dollar amount. Maybe it's like 100,000 for a platform and it's 20,000 for an add-on, or 10,000 for an add-on. Certainly seen that, and I think that should be influenced by like if it's a real consolidation play or a buy and build strategy, then maybe it's makes sense to kind of lessen the amount if for an add-on closing. But people definitely think about that.
I'd just say anecdotally, through all the conversations I've had, like when I think about how comp structures look from, because I try to keep a finger on the pulse and keep in touch with a lot of BD professionals, just like you do in the space. I think what I've generally heard is like when I look at the performance based piece of compensation, to me it feels like there's kind of a 50-50 split between like folks if they're being compensated just on like total transaction volume versus like size of the deal. To me, that's kind of looked like a 50-50 split most of the cases. And I've seen like for if you get paid just a flat fee on a per deal basis, like it seems like that typically looks like a kind of 25K sort of number for lower middle market sort of firm. Now, given like that obviously varies depending on a little bit on like the size of the firm, the size of the checks they're trying to write, et cetera. But like it seems like that's kind of been a fairly standard number for if they're just doing like, hey, you just get paid a flat amount for, a deal that's sourced if it's a platform. And then for add-ons, to your point, like it seems to be that it's kind of like, oh, okay, like here's a, if you do an add-on for one of our portfolio companies, if I'm paying you a flat fee, it's, maybe a 5 to 10K sort of check sort of thing. Now, given that's, from my experience, also vastly different from what it looks like if you're actually getting paid a percentage of total enterprise value, or a percentage of the total capital deployed there, right? And so it's interesting to me. Like there's this a little bit of a push pull for people that have been inside of the deal origination space for a while, where they know about like Lehman fees, and about buy side deal origination fees, and what that comp structure looks like, right? And so like if you're familiar with the buy side, that like the most typical fee is a Lehman fee, and the way that works is a sliding scale of 5, 4, 3, 2, 1. But like maybe just the simplest way to think about it is it's a little bit more than kind of 1% of total enterprise value once you get to a certain size, right? And so like if we just took a 1% number and use that as your starting place, and you say like, okay, this is how I'm going to get compensated, is 1% of total enterprise value for a transaction that I originate that gets closed, right? Then I think as a BD professional, you start to, as you're sitting there inside of a private equity firm, say, oh, okay, well, there's my anchor, right? Of like, I know, like if I was out here just doing this on my own, like I can get anybody to pay me a Lehman fee if I proprietarily originate a deal, right? How does my comp internally relate to what I might get if I'm doing buy side externally, right? Now, given like you have to take into account the fact that if you're doing it buy side externally, you're on your own. Like you got to pay for all your own costs. Like you're not getting a salary. Like you're just getting paid on the success and for every transaction that gets completed. Not to mention like having to pay for subscriptions to to data platforms and CRMs and outreach automation and everything else, right? Like you got to cover your own bases. And so like it's not really a great corollary to look at like, is 1% my number that I should be getting internally? Because no, it's not, right? Because like the firm is paying for all your costs. But it at least gives you something to look at as you think about like how to measure, how to compensate a team internally, like how to think about like what that upside should look like. Because there's a pretty well established track record of paying buy side fees. Now, given like some people will pay me even today, 5 or 6% of total enterprise value for a transaction that I originally put in front of them. But that is far and away not the norm, right? Like the norm is like, hey, 1% if it's actually truly proprietary, and if you actually get me in front of them and provide me with a meeting and we actually close the deal, right? And for some, like there's for sure, cases like 2% like is not unreasonable if it's an attractive asset, but it also slides the other way, right? Which is to say that like if it actually ends up getting banked, most buy side fees will provide some sort of haircut in there, where like either you get half of a fee or you get 25% of a fee, or maybe you get zero if it ends up being banked. It really totally depends on the firm and what you negotiate. But the only reason I bring all that up is just to like give some anchors as people are thinking about some of the ways to like, build and compensate teams, as well as for individuals to understand like what are the other things that exist inside of the market today, as you think about like what should compensation be for private equity, BD and sourcing professionals.
Yeah, I think you're totally right. And maybe the reason why so many new buy side firms have popped up in the past couple of years, right? I've seen BD people leave to start their own. Yeah. So the incentives are strong.
They are, but the risk is also high, right?
For sure. For all the reasons above, right? There are a lot of things that you have to pay for to be effective. And you're kind of you're always waiting on that deal closing to get paid. But, just generally speaking, the BD function is maturing, like as the industry matures and more firms are thinking about these hires. Compensation is moving along in that same direction. So I think there are a lot of BD people who feel like they're underpaid, and in many cases they are, and they're doing that same type of internal advocating to the extent that they are able to. Yeah. And I think the trend is that compensation is kind of growing, and it's the gap is narrowing between the counterparts on the deal team, for the same level that the BD professional is at.
In terms of what you're seeing is like the BD comp is starting to get more on par with the investment team comp. Is that what you're saying?
Yeah, exactly. And what I just meant by the level is just like, the compare, if you're an associate, BD associate, or you're VP within BD, like your counterpart on the deal team, a VP on the deal team.
Got it. Okay. Well, let's wrap up our bonus discussion, because I know there's a couple other things we wanted to talk about. One of those is like, what are the typical percentages that exist? I was just laying out some of like what exists in the buy side world, but like, what are we seeing in the way of if it is incentive based or performance based compensation, and it is based upon total enterprise value or on dollars of equity deployed? Like, What sort of percentages have or multipliers have you seen used in the industry?
I haven't seen a ton of multipliers, but I'm curious to hear your feedback because I know that, or I think that Sarent had set it up that way. And I don't know if I fully grasp how it worked, but I think the idea was like if you're sourcing a few deals in a year or in a time period, you can see that multiplied, not just the maybe original percentage of dollars deployed. But what was the rundown there?
It's not an original idea, right? Like the reality is like it all just boils down to, sales performance compensation and right and like what are best practices there. And I think what we've seen is some people have started to adopt the practice of saying, well, gosh, like what if we had scalers or multipliers based upon the performance in a given year such that you can incentivize people to perform at the highest level, right? And so like when you look at this inside of sales organizations, what you typically try to do is like you don't want to have your rock stars just stop at a certain point, right? Because like you're going to have people that are just absolutely crushing it and on capital deployment, total transaction volume, dollars of equity deployed, number of add-ons, like they might crush it at all those metrics, but at some point, like once they're sitting there and they've made a bunch of money, it's kind of like, well, like why should I do more? Especially if you're compensated annually. If I get a deal done in the first quarter and I'm like, okay, like I hit my quota, right? Like I did. Everybody good, right? Like, okay, cool. I'm just going to coast the rest of the year. And so like you can see that happen. And like I've been in that seat where like I got a deal done in January and I'm just like, yeah, okay. Like I got paid, I'm good. So like I'll see you guys next year, right? And it's like, no, what you want to do is you want to set up the comp structure in a way where I feel incentivized, like every business development professional feels incentivized to go do that additional work. And one of the ways you do that inside of sales orgs, you do that inside I think you should do that inside of BD is to say, based upon some metric, right? Like if you do more, you get more percentage, right? And so firms will even do this at the firm or fund level. They say like, hey, if we get a certain amount of MOI or IRR in a given year, like our percentage of carry is going to increase, right? Or decrease. Like you can have a sliding scale both ways, which is like you need to hit this number. If you don't hit that number, you get nothing or less. And if you do hit that number and above that, you're going to get more, right? You do the same thing when you compensate CEOs, for instance, right? Or you do the same thing when you do earnouts, where you kind of say like, hey, you have to hit 90% or 100% of this metric on EBITDA or revenue or whatever, or retention in order for you to actually get this earnout. Like the same thing applies for BD professionals. Like you set the bar, like here's what your expectation is. You need to hit this number. And then, oh yeah, by the way, if you exceed this number by a certain amount, you're going to get X percentage more. And so the simplest way to do that is just like take whatever you're measuring and put a multiplier on that, right? And so for instance, if it is like baseline, if you're just kind of covering your nut in a given year and you're just like, okay, great. Like I hit my bare minimum, which is like I deployed 25 million this year. I don't know what the number is. It might vary for every firm or it's, I got one transaction done or whatever. Right. And you say, that's the baseline. That's what our expectation is, that you need to at least hit that number. But what you want to do is for the ones that hit that number, what's the next hurdle for them? And what's the next hurdle? And what's the next hurdle? Right. And like, you don't have to have an infinite number of hurdles, but to a certain extent, you want to incentivize folks to do more. And so like, if I get, 10 or 20 basis points at a starting point, on total enterprise value or on dollars of equity deployed, and then perhaps that jumps up from 20 bips to 30 bips if I instead of deploying 20 million per year, I deploy 30 million per year. So I went from 20 bips to 30 bips, right? And then at 30, let's just say that like at 30 million per year deployed, once I get to 40 million, then I jump to 40 bips, right? So then as somebody who's out there working their butt off to do these deals, like I get one deal done in a year and I'm like, yeah, I've hit the bare minimum. I'm like, sure, check that box, right? But I also still have these other targets that I can hit of like, okay, not bare minimum. I want to be a top tier performer, and not top tier performer. I want to be a rock star. And like when I get to rock star, that's when I really get paid, right? And like, so why wouldn't you want to incentivize your best folks to like crush it every year, right? So that you can go and like, and the way to do that is like, say, here's this sliding scale. Here's a multiplier that applies, again, whether it's on total number of deals you do, it could be total platforms, total add-ons, it could be a mixture of those things. You do this number of platforms and this number of add-ons. It could be total enterprise value. It could be dollars of equity deployed. But you set like, here's what I want you to do. And then like, if you achieve this next hurdle, you get this. If you achieve this next hurdle, you get this. Then I'm incentivized to like go crush it every year. And that's where like, yeah, I mean, helps me make a lot of money, but like it forces me to work, right? It forces me to do what's in the best interest of the firm, and you would develop these aligned incentives. And so I'm a total advocate for it. It's a best practice in sales, and it's something that needs to be adopted in PE.
Another thing we'll talk about is just the carry component, and how that is also just like another incentive, long-term incentive to have someone, want the firm to do the best deals and, to deploy capital. And like it's all kind of, pointing in the same direction as the rest of the firm. But yeah, I can see why.
One other piece I want to touch on before we kind of jump into the carry piece here is really around like other types of bonus that can exist, right? One of the things that I've seen and experienced throughout my career is in private equity BD, both as outsourced buy-side deal origination as well as in-house, is it's a competitive profession, right? Like just like sales, it's like, you got to grind, you're competing, you're going head to head against other people in the firm. Like you might even be fishing in the same pools where like, whoever finds the asset first kind of gets it, right? But the thing that I've found as a result of that is like you need to also incentivize teamwork and collaboration, right? Like it can't all be based upon individual performance. Like there is a team element to it, especially as you get to the point where you have multiple team members in there. And it was actually one of my first recommendations when I joined in at Sarent too, was to say, hey guys, like we need some sort of team component to this, because I'd experienced it before where it's like if you don't have that, there's no incentive to kind of help each other out, right? Like given like, sure, you want to hope that everybody does the right thing and like we're good people and we hired the right people and like they're going to, have the guy, like if I've done a bunch of ed tech deals, like send me the ed tech deals. And if somebody else has done all the healthcare deals, send them the healthcare deals, right? But like when you're sitting there in the moment and I'm the ed tech guy and I get a healthcare deal that's sitting on my plate and I don't get anything if I give it to somebody else, like I'm massively disincentivized from sharing it with anybody, right? Like even though my colleague might be way better at doing healthcare stuff, I'm going to be like, no, I want this deal. I found this deal. This is my deal, right? Because I want to get paid on this, right? Because if it gets done, I get paid on it, right? But if you find a way to build in a team component in there where the success of the team is also your success, then it incentivizes people to do the right thing, which is like, oh, okay, I got this healthcare deal, but like, hey, if my colleague Michael gets it done, then like, I'll also get paid, something too, and maybe not 100%, but like I'll get something out of that. And so like we all win, right? And I think having that team component, I think is really important for just aligning incentives for everybody to do what they should be doing, which is like have the best person for the opportunity work on that deal. And also like if you're overloaded, like, share the wealth a little bit, right? So that's another important piece to me to include in bonus. I don't know. Have you seen other people doing that?
Team bonuses, yeah, and I totally agree with how you laid it out. I think it's when you start to build these teams, you kind of naturally enter an environment, like a competitive environment, and you don't want to lose out on opportunities because of that. So fitting a way to compensate everybody for the team success, it's something we see a lot.
Yeah, makes sense. We've talked about base, we've talked about cash base and cash bonus, but like there's this third big piece that's, like you said, kind of equity and carry sort of compensation. So do you want to maybe just start by giving folks an overview if they don't know, like what are those things and how does that typically look?
Yeah, so carried interest, right? It's the big piece of the industry, how people really make money, and the BD folks are no different than that. What I would say is like the general rule of receiving carry in private equity is that it typically happens at the VP level and above for any kind of professional, or mostly for investment professionals. I'd say that that's also true for business development professionals, but less so. Like there are more VPs and more senior BD people out there that don't have carry than there are their counterparts on the deal team. So it's from our survey, I think it was 55% of the people who participated had some allocation of carry. Not to get into the ranges, but just any amount.
Is that across all levels, or is that at a certain level?
That was across all levels, like the entire pool of folks that participated. But I believe it was I think it was about 60% or so that were like VP level and above, maybe even 65-70% of the respondents in that survey were VP level, director, principal, head of MD and above, so it was mostly or heavier weighted towards more senior people.
The survey as a whole was weighted toward more senior people, right? Okay.
Exactly.
Got it. And so like it might be fair to assume that something like, 55 to 60% of senior folks in PEBD have some sort of carry component. Is that the right way to think about it?
Yeah, I mean, I would think that it's a bit higher than that,
Okay.
but it's not 100%.
Yeah.
And I think it's just important to know because the counterparts on the deal team, I think you get closer to that 100%.
Got it. Yeah. So like investment team professionals almost always have some sort of carry once you get to the VP level. On the BD side of the equation, like not all the way there, but it sounds like it's increasing and it's more frequent and common that like the majority of folks do have some sort of carry component once you get to the VP or level above in BD sourcing. Is that right?
Yeah, exactly.
Yeah. Okay. Do we have any metrics around how much carry and like what the ranges of different carry packages that folks get in terms of basis point? If we don't, that's fine, but just curious if we've got any evidence around like what that looks like, what the actual carry packages look like for folks.
Yeah, I mean, it varies so much. I've posted on LinkedIn about this here and there. So there might be some numbers in some of the reports that we've done. But offhand, we don't have it by like title or anything like that. It just anecdotally, it is varied.
Yeah.
It's kind of the Wild West as far as as far as compensation goes generally, but also like carried interest goes and the amount that folks have in the seat. And I wrote something about just how I think it's a good example of like how firms value the function. It's an indication of how much a private equity firm values BD. And there are plenty of good firms out there with BD people who have impressive backgrounds that don't have a carry allocation. But again, I think we're kind of headed in that direction. This is becoming more of an important role, and I think with more comp surveys, hopefully that's useful for people who are in this seat and kind of advocating for themselves to get a share of that.
I think what I've seen, to your point, like it varies greatly from folks that I've been talking to about this and like what do their packages look like. To your point, like there's a lot of folks that still don't have it yet, like don't have any sort of carry component. But for the ones that do, I've seen it range from, hundreds of thousands of dollars per fund to, a couple $1,000,000 per fund. Now, given like that's just making an assumption that it's perhaps like a lower middle market fund, and like maybe they've raised between 250 million and 2 billion, somewhere in that range. Like those are most of the folks that I've talked to, and so it's generally in that sort of range. I think on the upper end, I've seen some cases where it approaches closer to like a 5 to 10 million in carry per fund, but that's for a bigger fund and like for folks that are really aggressive. I don't think that's anywhere near common. I think generally it's hundreds of thousands of dollars to millions of dollars worth of carry per fund, given the assumption that the fund actually performs and gets to a certain degree of performance that and then there's also the big assumption that the folks need to understand and know here, right, is that like that carry typically vests over time, just like any other sort of equity. And it's oftentimes not worth, anything until and if the case that the fund actually, liquidates assets and actually, returns. Usually, like you have to first hit your hurdle rate, right? And like you have to be able to actually be returning dollars to your LPs. At which point, like you might get to the place where you're able to start showing that like your carry is actually worth something. And for some funds too, like you're not going to get anything out of that unless you've actually stayed there for the entire length of the fund, right? Or at least many years into the fund. Because just like equity you might have inside of a startup, like part of what carry is doing is like it's incentivizing you to stick with the fund for a number of years, and like your value at that fund is going to build year on year for the number of years that you've been there. And I've seen some cases where it's like, hey, look, you're not going to get 100% of your carry unless you've been there for the entire fund life. And most fund lives are still like 10 years, right? And so like it's a long time that it takes to actually realize that value.
That's why they call it the golden handcuffs.
That's right. That's right.
Many people who can't leave because of that same scenario. They're kind of nearing the end of a fund deployment, and they want to, they have a good line of sight into what that might mean for them. So
let's just hit. You mentioned equity. Like, is that like equity in like a per portco sort of basis, or like what did you mean by that?
Yeah, some firms will do that. Exactly. So maybe maybe you want to think about it as another additional bonus structure, but it's not an annual year-end bonus. But a way to, again, incentivize business development professionals is um, an equity piece in the company that they source. And so that, unlike the carried dynamics that the carried interest dynamics you just walked through, that would just be tied to that single investment. And so, like any investor in that company, it would be paid out upon exit of just that deal. So that's something that we've seen anywhere from just a few $1,000s of equity, kind of like in a team wide bonus, to some structures where there's a multiplier where it's $1,000 of equity per $1 million deployed, and that can be a substantial amount depending on the size of the deal. So it's another way that firms can try to incentivize these folks to find deals.
Well, look, I think we covered base and bonus, as well as carry and equity pieces. So I think we probably hit most of the comp structure here. How is this evolving though? I mean, I know we talked about this a little bit, but like, do you see any trends around comp structure for PEBD that we haven't touched on, or like where's this going?
I think an important thing to note is that not every private equity firm is the same, right? And so their approach to business development is going to vary depending on a lot of things: investment strategy, what type of companies they're going after, and what are the right channels to find those companies. How many deals they're trying to do? Are they a firm that's looking to deploy the fund really quickly in a bunch of deals? Is it a more concentrated fund where they're doing a less amount of deals? Are they quickly looking to grow the fund sizes? Like, let's deploy fund one quickly, and then we're out raising fund two. Or are they a small fund that intends to stay small? And so they're, maybe they're value focused, or maybe they're, just a bit more patient. And all of that is going to influence a lot of things surrounding sourcing, who you hire, but also as it relates to our conversation today, how you structure the compensation. And so I think it's just like important to, if you're listening to this out there, to keep that all in mind, that what we're saying doesn't apply to every single firm. And so if you're if you're in a seat at a PE firm, and the range that we threw out is way off from where you are, there's a lot of nuance to this. So I think that's just kind of one thing to flag. We talked a bit about some of the trends. I think there's a trend to build proprietary sourcing teams, and I think there are specific comp structures and trends for how those are structured within that, and the different like sales structures that you kind of walked us through seem to be more prevalent in those scenarios. But I think I mentioned this before. I think we're headed forward. The folks that are in these roles are seeing compensation grow. It's the gap between the deal team and the BD professional is narrowing, and I'm betting that will continue to happen.
Yeah, I mean, I don't think my perspective is too much different, which is that, look, generally private equity BD is going to lead the way into the future, right? I know like a lot of people are gonna him and haw me for that, but like the reality is sourcing is only going to increase in importance. Like go-to-market strategy for private equity firms is only increasing in importance as we go, and we're already seeing that like through the growth of this space, right? That we're seeing more private equity firms every day hire their first business development professional, sourcing professional. We're seeing for every firm that hires one, they almost always hire two, right? Because like once you dip your toe in the water, you realize that like you've got to have this. And then you're also seeing that like once you kind of get the sourcing engine going, you're starting to see that like, okay, like we've got to incentivize deploying more capital. Like we're effective at this. How do we get our sourcing team to be as effective as possible? And that's where like as teams scale and grow, you see the shift going from a place where it's discretionary bonus to a place where it's performance-based, bonuses and compensation. Like it's going the way of enterprise sales, right? Like that's really the place that it's going, which is like you're going to have these big sophisticated teams that have, fully dialed in their comp structures in a way where they're incentivizing the best and highest performers and attracting the best and highest performers. And the ones that do that perform at the highest levels are going to get compensated the most, right? And ultimately, just like you have in most organizations, the top performing business development professionals are going to become the top paid people at private equity firms. Like hands down, that is the answer. We're not there yet, but that's the way that it's going to be, and it has to be, because like this is one of the three major needle movers within private equity firms. It is like deploying capital is whether a firm, lives or dies, and it's whether you're a top tier, top decile, top 5% sort of fund returner, or whether you're a bottom tier, right? It all comes down to whether or not you can deploy capital. And so to me, like that's the way it's going. We're not there yet, but as I look toward the next 5 to 10 years, BD professionals and PE are going to be the highest paid people in private equity, hands down.
Do you think that applies to all firms, or is it specific to kind of what I was saying before, like how firms have different objectives, in the short term, medium term? Like, are they looking to do a lot of deals? Or are they looking to grow their fund size? Like what you're saying, do you think that applies just to the industry at large, or there are pockets where that is more applicable and less?
Yeah, I mean, look, like if it applies toward the folks that are going to be the most competitive and in the most competitive positions and are looking to deploy the most capital, right? Like if you just raised your first fund and you've got $100 million fund and you're focused on deals that are doing 1 to 5 million in ARR, there's not a ton of competition in that market, right? And so like, do I need to compensate my BD people at the highest levels there? No, probably not, right? But as your fund size grows and you get to the point where like you have a 500 million, 750 million, $1 billion, $2 billion sort of fund, and you start to play in this space where you can still do proprietary deals and it's not just all bank deals, right? Like there is the ability in the lower middle market to effectuate and catalyze transactions. Like that's the place where it belongs, and that's the place where people are going to get paid the most, and that's the place to me where firms should be compensating people the most that are the highest performers, is the ones that catalyze and get transactions done outside of an investment banking process, right? Like that's because that's where there's the most value for a firm, right? And sure, I mean, you could say you can do that for somebody that's focused on lower middle market and like these tiny deals, but like then it's going to be more of a volume game, right? Where it's like, hey, can you get 100 transactions done per year, right? And that's usually more of like a roll-up sort of approach. And sure, like some of those folks are getting already compensated with a 250K base plus bonus and some sort of equity or carry sort of component, right? Like that does exist in some cases there. But to me, like the place where the people are going to be the highest earners is going to be in that margin below where everything is run through an investment banking process, and above where it's tiny in that lower middle market. Like that's where you're going to have the highest paid BD professionals.
Look forward to capturing that in our, I don't know, 5 or 10th annual survey that we can.
Sounds good. One of the things we wanted to wrap up with here is like, gosh, if we were, going about launching our own thing here today, right? Or we're trying to stand up a BD team, like what would we do, right? What would our advice be for our firm in terms of building the team and compensating that team? Is that right?
Yeah, I think that's a good way to put it. I mean, it's certainly something that we think about and have conversations with firms about, and the context is really important, right? Like the questions that you have to kind of ask to determine what's the right profile for you, whether we need to build a team, how quickly, those types of things. But yeah, I'm happy to hear your thoughts on it. If you were kind of given the reins and you've been in a position where you've built a team before, but however you want to frame it, like what you would do, how you'd think about building out a team to out of the gate.
Just like anything in sales, or just like anything with humans in general, it's like you got to start with, what are you trying to incentivize, right? Like that's the first thing. What actions, what activities, what daily motions, weekly, monthly, yearly motions do you want to incentivize people to do? And like just design around that ultimately. And so you've got to have some sort of base component, right? Like to keep people going and pay for their bills annually. I've been in a place where I've had draw versus commission, where like I earned a $36,000 a year draw that I had to pay back based upon deals that I got done. And I will tell you that after 18 months of not getting a deal done and realizing that all of that is not actually compensation, it's all debt, that really it eats at you, right? It really does. And like you start to look around the corner and be like, what am I doing with my life? Right? Like I have made a horribly bad decision here, right? And like that's the reality. Like because like there are sales compensation structures and BD compensation structures that look like that, right? Where it's like it's not truly you getting an actual salary, it's you getting something that you have to pay back. And that, like, to me, that's toxic. I don't believe in that at all. I don't think that that's the right way to go. So I think you have to have some sort of base. You give people something to live on, but you don't make it comfortable. That's why I believe in like having this 50-50 split, because there has to be something to achieve. And to me, it can be even more than that. But I think the base place to start is you say you've got a 50-50 split between base and bonus, right? And so like, here's to your point, we've talked about what the on-target earnings sort of number can be, but like you need me to be hungry, not starving. I don't believe in starving, but I believe in hungry, right? And so like, if you can put me in a place where like, okay, maybe like I could go get another job where I would earn 150K or 200K sort of base, and like I would feel comfortable, right? But if you instead say to me, no, you can earn 200, 300, 400 per year, but like you start here, right? And the rest of it you have to go earn. You got to go get it, right? And that to me, like you got to start with that, which is like have again 50-50 split, some sort of base, some sort of upside, right? And that upside piece is the part that you got to go earn. Now, that upside piece, again, we can break it into lots of different subcomponents, but to me, you got to have some sort of team component, right? Everybody's on the same team. We're all helping each other, assuming you have more than one person, right? And so like my success should be your success. We should all be incentivized to get to success together. That should not be the majority of that bonus, but it should be some small percentage of that, right? So maybe I call that 10% of that or whatever is kind of this team related component. Then the balance of it should be, from my perspective, all in the bucket of individual performance, right? Like those are the things I've got to go earn that just myself, nobody else, right? I got to get it. And then, so like I talked about, design this around what you're trying to incentivize. What are the set of things that you want me to do in a given year? One is maybe you want me to get a certain number of platforms done. Two is maybe you want me to get a certain number of add-ons done. But maybe more than just number of those, what you actually care about is dollars of equity deployed or total enterprise value in transactions per year. I will say that like from a firm perspective, if I'm sitting in the firm's shoes, the right way to do that is like, what are we as a firm measured on? Well, and what's most valuable to us? Like, I can't eat number of transactions done per year, and I can't, like, I also can't like for total enterprise value, right? Like what I can eat as a firm is the dollars of equity deployed. And so like, that's where there's a direct incentive, the direct alignment of incentive between a firm and between an individual is like when they're incentivized based upon what you're incentivized on, which is like, get the dollars in the ground. Like, that's what you got to do, right? Now, given from an individual perspective, it kind of sucks a little bit because it's outside of your control in terms of like what the final check ends up being. Because I've had cases where it's like, hey, this is going to be $100 million check. And then, oh yeah, just kidding. Like we're only doing a $75 million check, right? And so like my compensation on a bonus, if it's based on BIPs or whatever, just reduced by 25% was something that's totally outside of my control, right? Anyway, but you got to start with those big pieces of what you're trying to incentivize and line your incentives. I do like the idea of having it around like alignment of like dollars of equity deployed, I think makes sense. The other one to me that makes a ton of sense is like total enterprise value of transaction. But again, it's a little bit misaligned between the firm and the individual when you do it that way. That said, for add-ons, that can make more sense, right? Because it's a little bit trickier. Oftentimes when you do an add-on, like you're not actually doing dollars deployed there. It might be entirely debt financed, right? And so like you can't strictly measure the dollars of equity deployed in that case. And again, depending upon the fund and the way that the fund works, because I know some funds that are doing both the debt and equity components of this, like maybe there's a place where you incentivize the debt piece too, or maybe you don't because like it's all, you only want to focus on equity. Again, up to the firm how you want to structure that, right? But then for those individual pieces, so let's talk about, you want me to do a certain number of platforms per year, not just number of platforms. You want me to deploy a certain amount of equity per year. To me, the right way to do that is like incentivize me again to like reach to the highest levels. And so maybe you have some sort of base tier where like I only get less than what's average, right? And so like if that's, normally it's 20 bips or 30 bips, but instead it's maybe 10 bips, right? Like it's something that's much less that I get. But then like if I far outperform, I'm getting much more in the way of like, percentage of total enterprise value or percentage of dollars of equity deployed. Because what you want me to do is you want me to reach to the highest level, right? So all of those things kind of are at least the starter ways that I think about it. So like the things that we touched on, base and bonus split, right? Some sort of variable, like 50-50 between base and kind of the variable component, some sort of team component to it, and then like incentivizing what you want me to do, as well as like some sort of scalar or multiplier to get me to reach to the highest level.
Well said. Yeah, I think that's a good way to do it. I think to me, this seems more like I'm building a team, right? I think that's the exercise that we're doing here is if you're going to hire multiple people, build a team. These are kind of the key components to think about when structuring the compensation package. And I agree. I think for me, for BD folks, just generally, whether it's a big team or a few people, I think having a mix of either metric driven bonuses and discretionary in addition to base salary is a good place to be because it kind of it allows for the person to have a realistic expectation of what they're going to earn, because the metric should also be like pretty easily defined. Like if I have to meet with 60 qualified companies per quarter or something like that, like schedule those amount of meetings, like I should be able to realistically determine how likely that is. And that part of my base or my bonus should be, close to guaranteed. I still have to do the work, but
I don't know about like guaranteeing bonus, but like what I do like your point about like having some sort of discretionary piece, because I will say that like when you get to the end of the year and you haven't gotten a deal done, but you've done all the right things and it was entirely outside of your control, but you get no bonus, like that doesn't feel very good. And so I do think like having that discretionary piece, I don't know what percentage that is, but like if you take some amount in here of that bonus piece and say a certain amount of that is discretionary, I think that can make a ton of sense. But you got to be clear to me, like discretionary is also like there should be some sort of something tied to it, right? Like not just a like finger in the air, like you get your bonus or you don't, right? Like to me, it's kind of like, are you doing all the right things? And to your point, like to me that makes sense. So maybe the restructured way of thinking of it, right, is like base and bonus split. That bonus piece, a good chunk of it performance based, some of it team based, some of it discretionary, and then obviously the
yep.
scalar multiplier piece we talked about.
Yeah, I think we're in alignment on that. I think it's a good way to think about it.
I love it. I love it. So I know one final piece I think we had here is like, for the firms out there, to be clear, like we're not trying to set the tone on what comp is or is not. We're just trying to give a perspective on like what we've experienced and seen here. So might not be perfect for you. Again, there's a lot of nuance here. We've said that a handful of times. But also to flip to the other side, which is like for the professionals, you're out there thinking about how to negotiate your comp structure, think about how to understand what your worth is and leverage that inside the firm. Like, I don't know, Matt, do you have any advice for folks that are thinking about those internal advocacy conversations and internal negotiations that they're trying to work through?
Get as many data points as you can, right? Talk to me, talk to other recruiters in the space. Try to find out as much information as you can. I know of people who have brought our comp survey to discussions with their CFO. You have to have the right relationship to feel comfortable doing that. But to the extent that you can bring some actual like hard data to the conversation, I think you should do that. And so I interact with candidates a lot around accepting a job and evaluating an offer, and they're thinking about, is this competitive, and those are the conversations we have. So I think when you're in that position, you need to go further and ask those questions. Like you might understand the comp structure just as you've outlined it, Dan, but like what is the likelihood that I'm going to be able to do that? Do we have the right team in place to actually execute on deals? Like if I'm entering a position where most of my upside is based on deals closed, what's the track record? What's like the likelihood that will occur, even if I do all the right things? And so if you're an associate, you're an analyst, you're coming out of like, 1 year of professional experience, you might not have that ability to ask for that information. But to the extent that you can suss that out, talk to team members who have been there before, and try to get an understanding of how many deals did the last person in this role close in the first year or the first 2 years? All those things are things to try to suss out, to try to figure out before entering a position.
You bring up an interesting point. You made me think about, which is, most folks will know this by now if you're in the profession. If you're not in the sourcing profession, like you might not know and see this, or if you're more junior, you might not appreciate this yet, which is your success as a sourcing professional is highly dependent upon who you're coupled with. And what I mean by that is, even if you're the best deal sourcing professional in the world, if you're with a firm that can't get deals done, or you're working with investment professionals that don't have the ability to get something across the finish line, you're not going to get paid what you're worth. It's an unfortunate truth of the profession that we live and work in, right? But it's also, when you're coupled with the right people, when you're working with the right firm that knows how to do proprietary sourcing, knows how to value business development professionals, doesn't have to be proprietary, but like knows and appreciates how to leverage your talents, you can make a ton of money in this profession, right? And you can bring a ton of value to the firm in doing it. But again, there's a hard pill to swallow here, which is, if you're coupled with the wrong folks in the wrong firm that doesn't have the ability to get deals across the finish line, I don't care how good you are at it, like you're not going to get what you're worth at it, right? And that in mind, like, sometimes it means there's conversations to be had here about like where do your talents best belong? Or the other side, and the reason I thought of this is, like, Matt, as you're talking about comp structures and you're talking about negotiation and you're talking about walking into the CFO's office or walking into the partner's office and talking to them about comp, I'm going to be straight honest with you. If your firm doesn't know how to actually get deals across the finish line, you're better off having a comp structure that looks more like base with discretionary bonus than you are having something that's performance based. Because at the end of the day, like, if they can't actually get deals across the finish line, it's not your fault. Like, then maybe you don't want it to look like that, right? Like, again, I'm not trying to say that that's what you should do. Like, to me, the better thing to do is like to actually build a firm where you can get deals across the finish line, and have a comp structure where you're compensated based upon what you actually deliver there. But like, that's the reality, right? When we're talking about, how do you want to build this and what do you want to fight for? It does come down to like what your fund and what your firm and what your team members on the investment team can actually accomplish.
Context is important. There's a lot of nuance to all the things that we're talking about here, but hopefully some of the stuff we pulled out and shared today is valuable for people. Maybe other folks will have questions. Anybody who's listening to this and wants to hear us talk about other topics, reach out, suggest different topics or guests that we can talk to for upcoming episodes. Anything else, Dan?
No, look, I think that's it. Look, I mean, I think for folks that are listening in for the first time or multi-time listeners, like the holds regardless, that I think Matt and I are open books as it relates to this. Like, both of us love talking about these subjects. Both of us want to see, folks in this profession be successful at what they're doing and kind of help both firms and individuals get there, right? And so, reach out, give us a shout. We love having one-on-one coffee chats with folks. To Matt's point, we'd love to know what other topics we should discuss that you'd find most valuable. We've got some great things coming up, both in the way of talking to existing founders and like hearing their stories about how they, how they built their business and who they ended up talking to in private equity and what sort of messaging and engagement that they found most engaging, and that, why they ended up doing a transaction with the private equity firms they did deals with. So we've got some of those good conversations coming up. We've also got some good ones around like how to, best practices in sourcing, like how to leverage your portfolio, how to do add-ons, like, a lot of cool topics coming up. But number one thing is we want to talk about whatever's most interesting for you all. So if you got a topic, let us know, give us a shout. If you want to catch up, shoot us a note. Our information should be available here. But thanks for joining. We're excited to have spent this time talking about compensation structure with you guys. Hopefully you found this valuable. Subscribe, give us a like here. And we'll see you next time.
Awesome, Dan. Great chat.